Hello, good morning. It's Wednesday, 13th of March. Today I'm joined here by Sten and Matthias. We're going to just take a look at the Brexit first of all, because the despair, I think, among politicians and among the UK population continues to grow. Just take a look at some of these headlines from today's UK papers. We can see that after May, Theresa May suffered another defeat, albeit not as big defeat as last time. We're still left with no idea about what's going to happen next. Another day, another defeat, Sten, and really, yeah, we got another vote coming today. What should we say about it?
Yes, so I like the Daily Mail's front page, the House of Fools, because that's exactly what's going on here. We have indecisions. I think also, interestingly enough, Newsnight, the BBC's main news story of the night yesterday, carried the story or lead into the first story about the Brexit, where they basically said no one knows, no one has any ideas, anyone claiming to know anything will be lying, and this is the worst ever. And if you, dear viewers, think this is terrible, imagine being on the other side of this, asking questions about nothing all the time. So I think there is a Brexit fatigue. I think the market is, however, extremely calm relatively to the potential outcome here, because what has transpired over the last couple of days clearly is that the hard deal has become a higher odds probability. The vote today is about the hard deal, so tonight we will get a straight up vote. The most likely, of course, being they will not accept a hard deal, but including in all these votes that will carry on to tomorrow at the Article 50 is Prime Minister May going to remain in office? Will there be carried a motion in the Parliament about her conducting the affairs in front of the Parliament? There is a huge disbelief in her ability to navigate, and I think it's pretty telling that she lost her voice as well yesterday.
Yeah, and today she's got the Prime Minister's question time at 12 as well, so it's going to be a very trying day for the Prime Minister. And I think also the fact that we're seeing the sterling, we can just see a chart here, it's basically completely stuck here. We had some volatility yesterday as the news came in, but I suppose market is trying to find some positive news here, because they say, well, the longer it takes, potentially the higher the chance that we can have a revote or completely trying to forget that it all happened in the first place. But I suppose that's really not, we cannot take it like that.
No, we can certainly, and certainly the investors is taking it like that. When I talk to investors around the world, they are all long sterling. They're all buying this concept that there is a better deal than the hard deal or a deal that is destructive for the UK. I do, however, think there's too much focus on the Brexit. If we look at the actual underlying economic trends in the UK, the credit facilitation in the UK is contracting by 2% to GDP. We had a GDP number yesterday barely making 1% growth year over year. We have a Bank of England who's maintaining relatively hard monetary rates, too high monetary rates relatively speaking. I think a rate cut is only priced at 17 to 20% end of the year. I think that is more likely to be 60, 70 on the economics alone. And now imagine that we have the most likely outcome, which is to have an extension of the Article 50. Then we need to define how long it will be and all these practicality. But while that is happening, there will be no new investment going into the UK. There will be more disillusion from business people and the likes. It's not that I think business cannot deal with this, but they need an actual deal now. They don't want to be kicking down the can constantly.
They hate the uncertainty most of all. And Matthias, just talking about the sterling and you brought us the volatility and the market seems to it's a little bit more relaxed. But what's your take from the volatility space?
Yes, I mean, we saw really elevated vols yesterday before the vote. For example, overnight volatility was 40% in cable in the morning, but it gradually traded lower during the day, and ahead of the vote we were down to like 20-25% in the overnight vol. But now afterwards we see that vol is marked lower. 1 week is down from around 17 high before the vote to 13% now in cable, and 1 month is down to around 11.5. So we see a little bit lower volatility now after the event, of course, as we usually see. But also we see a little bit more priced in on the risk reversal. So it's more bid for sterling puts now. Yeah. So we have one way out is gone now. So it's more risk for a hard Brexit or no deal. So sterling puts is a little bit more expensive.
But also looking the drop in volatility clearly indicates the market is expecting that that tonight's vote to leave without a deal is going to be defeated. That will move towards the next
today we don't price in too much risk. I mean, it's more interesting what's going to happen tomorrow on the next vote. So.
Thank you. Well, just staying with the currency space, the euro-dollar has been grinding high after this, what looks like now a failed break to the downside on late last week. And just looking at the chart here, we can see we are obviously getting squeezed into a tighter space here. We have seen from the non-commercial positions in the euro-dollar futures that we are currently holding, that's currently net shorter, which is at a 2-year high. So that does raise the risk of a short squeeze here, even though obviously it's not really euro strength that's driving this, is probably more weakness elsewhere. But just look out, if we start to make it back above this 113 level, we could potentially see some short covering hit the market. Elsewhere, we're seeing the stock. We're seeing a little bit of risk aversion coming into stocks again overnight. The yen strengthened a bit. We saw the Nikkei trade lower, but also in the US, we tried to put in another strong performance yesterday. It did fail towards the end of the day, and some of that is translated into the bond markets. We had a renewed strength in the bonds. We saw CPI weaker than expected yesterday, obviously pushing further out basically removing expectations for rate hikes. So that really is the biggest risk right now. Even though the numbers are not, it's basically supporting the fact that we're not seeing any hikes. Just look at this chart, the top left corner. That's CME's FedWatch tool. This is where they look the percentage probabilities where rates are in a year's time, or no, next January. And you can see now we are completely moved away from expecting any rate hikes. There's now a 25% chance of a cut. So that's supporting bonds. We can see the 260 level is quite critical. Do you want to add a comment to the yields there, John?
I think it's the fact that everybody looks to the US as a leader is wrong. It is China that leads, and we've seen China massively stimulate the economy through monetary easing and now also fiscal expansion. The US is just late to the cycle, so we are having a catching up effect. So unlike what the market actually argue, we have US now following the path of the rest of the world. And if you look at the global supply chains, which of course the US benefit massively from, despite Trump's objections to it, then we're clearly seeing that the US is in a slowdown. Atlanta Fed, which is sort of a leading economic growth indicator, is now almost back to zero. If you look at Chicago Activity Index, which we use as the broadest measure of the US economy when we're moving into negative territory. So, we're not talking about a recession, but we're definitely talking about a US economy which is slowing down. And the problem with that is that everyone in the world is arguing the US is doing just fine. They are not doing just fine. They're actually slowing down dramatically. However, in terms of the euro parity and the fixed income market, I think Europe is in a far worse place. Not because of Brexit, but just simply because we haven't been able to be constructive in terms of solution of fiscal spending, in terms of infrastructure investments. We are way behind and led by Germany on the negative side.
And also, it raises obviously the usual question: if bonds continue to go up, can stocks continue to go up as well? So one of these two probably has to give sooner or later. So continued weakness in yields, obviously reflecting a weakness in the economy, and that raises some concerns for the stocks going forward. Just taking a look at a couple of some of the opportunities elsewhere. In gold market, we broke above 1,300 yesterday. The weaker dollar and lower bond yields clearly helping, and weaker CPI yesterday clearly support a recovery there. So we have bounced off that key level down towards the 1275, 1305 today. If we break above that, and I think we start to see some additional buying coming back into the market. In the oil market, there's a lot of positive news continue to drip into the market from the supply side. But if you look at the price action, it's really just grinding higher. And even though there is a bullish, the market remains bullish as it states, there is still this risk that if we see continued weakness in the economic data, we're going to struggle to the upside. So the story in Brent remains the same, stuck in a $64 to $68.5 range. The EIA reporting their weekly stock numbers this afternoon. API last night came with a surprise drop, and that has added some additional support overnight. And then just finally, we talked about the grain market yesterday, that about the big short we currently have across the whole agricultural space. Just take a look at wheat here. We did see a bounce yesterday, quite a strong one. And but at this stage, we are the best you can hope for in some of these grain markets is short covering, because the fundamentals are still pretty heavy. So 464 is the first key level of resistance to the upside there in wheat. And then just finish off with the macro calendar for today. We got industrial production from the euro area for later in this afternoon in the US, PPI and durable goods. And then this it looks like it's going to be 7 o'clock UK time tonight that we're going to have that vote on a no deal withdrawal. So again, a lot of focus once again on what's happening in the UK Parliament. All right, we'll finish it there, and let's see if we're more wise tomorrow. Probably not, when it comes to sterling at least. But
we are not, I guarantee. I guarantee we are not.
And so we'll be back again same time tomorrow. Thank you.